Every paper currency ever created by every government in human history has eventually gone to zero. Every single one. The Roman denarius, the German mark, the Zimbabwean dollar, the Soviet ruble, gone. All of them. And every single time in the weeks and months before the collapse, the people holding that currency were told everything was fine. Right now, 3 of the world's largest central banks are quietly buying gold at the fastest pace recorded in modern history. They are not announcing it loudly. They are not explaining it on television. They are just buying. And if the institutions that print money are choosing to hold gold instead, you need to ask yourself a very uncomfortable question about what they know that you don't. The world is closer to large-scale conflict than at any point since 1939. Supply chains are fracturing, currencies are under pressure, and the single asset that has survived every war, every collapse, and every monetary reset in 5,000 years of human civilization is sitting in most people's portfolios at exactly 0%. My name is Jordan, and I've spent years studying what happens to wealth during extreme geopolitical events. Not the calm water advice that fills most financial media the edge cases. The scenarios where the normal rules break. Gold shows up in every single one of them. Not as a get-rich asset, as a survive intact asset. And right now, that distinction matters more than it has in a generation. The people who dismissed gold as a relic, a conspiracy theorist's medal, something their grandfather kept in a shoebox, are the ones staring at their portfolios right now, wondering why nothing is holding. The people who understood its role weren't the paranoid ones. They were the prepared ones. Here's what we're covering. I'll show you what gold actually does during major geopolitical crises. Real price data, not theory. I'll explain why a World War III scenario is specifically the environment gold was built for. I'll break down how much gold actually belongs in a portfolio and in what form. And I'll give you the exact steps I'd take right now to build that position before the window narrows. Think of gold like a fire extinguisher. You don't keep one because you expect your house to burn down. You keep it because if it does, every second without one is catastrophic. And having one costs almost nothing relative to what it protects. A portfolio without gold exposure in a world where geopolitical risk is rising isn't a brave portfolio. It's a portfolio without a fire extinguisher. Most of the time, that's fine. In the specific scenario we're discussing today, it is not fine at all. This isn't new. Let me show you. Go back to 1971. Nixon ends the Bretton Woods Agreement, the system that had pegged the US dollar to gold at $35 per ounce since World War II. The moment the dollar was untethered, its value became entirely dependent on confidence in the US government. Gold, suddenly free to trade at market prices, went from $35 an ounce to $850 by 1980. In 9 years, gold gained over 2,300%. Investors holding dollars lost purchasing power every year to inflation. Investors holding gold more than kept pace. The lesson wasn't that gold is always a great investment. It was that gold is a great investment specifically when trust in paper money is under serious stress. 2008. Global banking system on the edge of collapse. Governments printing money at speeds previously unimaginable. Between 2008 and 2012, gold went from roughly $800 an ounce to over $1,900, a gain of nearly 140%, while the S&P 500 was still recovering its losses. Investors who held 10% of their portfolio in gold going into the crisis didn't just feel better, they were materially wealthier at the end of it. Then 2020, a global pandemic, $4 trillion in emergency Fed money printing in 8 weeks. Gold hit an all-time high above $2,000 for the first time in history. Every time institutional confidence in the financial system wobbled seriously, 1971, 2008, 2020, gold moved. Not randomly, systematically. Because gold has one property no other asset replicates. It holds value when the systems that give other assets their value are themselves under threat. Now the World War III specific case, because this is where gold's role becomes something different from every other scenario. In a standard recession, equities fall and bonds rally. In a standard inflation spike, commodities rise and long bonds fall. Portfolio managers have playbooks for both, but a genuine large-scale global conflict, one involving major power confrontation, disruption of global financial infrastructure, and real currency system stress, breaks most of those playbooks simultaneously. Equities fall. Bonds may not rally if inflation is running hot from supply chain destruction. Cash loses value if governments are printing to fund military spending. Real estate is illiquid. In that scenario, where multiple asset classes fail at the same time, gold is the only major asset with a multi-thousand-year track record of holding value through the collapse of governments, empires, and monetary systems. Every major currency in history has eventually failed. The Roman denarius, the Byzantine solidus, the Spanish real, the British pound as a reserve currency. Every paper monetary system has either collapsed or been fundamentally restructured at least once. Gold has never gone to zero, not once, in 5,000 years of recorded human commerce. That is the asset you want exposure to when the question stops being, how do I grow my money? And starts being, how do I keep what I have? Now meet two people, call them Victor and Dean. Both are 44. Both have $250,000 invested. Both watched the same escalating news cycle through 2025 and into 2026. Victor had no gold. His portfolio was 80% equities, 20% bonds, a standard allocation his advisor set up years ago and never revisited. When geopolitical tensions spiked and markets dropped 19% over 8 weeks, Victor's portfolio dropped with them. He held, which was the right call, but he had nothing in his portfolio that moved in the opposite direction. No offset, no buffer. Just red, across everything, all at once. Dean had built a 12% gold allocation 18 months earlier. When the same market dropped 19%, his equity positions fell with Victor's, but his gold position was up 23% over the same period. The two offset each other. His total portfolio was down 9% instead of 19%. On $250,000, that difference is $25,000. Not preserved by being smarter, but by holding one asset that went up when everything else went down. 6 months later, markets partially recovered. Dean was back to flat. Victor was still down 11%. Same starting amount, same market, same news. One fire extinguisher made a $27,000 difference. Here's what most people get wrong about gold, and why they either own too much or none at all. Gold is not a growth asset. Over long, stable decades, it dramatically underperforms equities. It doesn't compound. It doesn't pay dividends. It doesn't grow earnings. It sits there and maintains its value against currency erosion and institutional collapse. Owning too much in a calm period is expensive insurance on a house that doesn't burn. But the solution to that is not zero gold. It is the right amount of gold. The right amount, based on decades of portfolio research, is between 5% and 15% of total investable assets. Below 5%, and the position is too small to meaningfully offset crisis losses. Above 15%, and you're dragging long-term returns during the calm periods that make up most of investing life. The sweet spot for most people is 8 to 12%. Not a bet on disaster. An allocation that improves risk-adjusted returns across a wide range of scenarios, including the ones we hope never happen. Action step 1. Calculate your current gold exposure as a percentage of total investable assets right now. If the answer is 0, you have no fire extinguisher. If markets drop 30% in a geopolitical crisis, every position moves in the same direction simultaneously. That is concentration risk. It is exactly what diversification exists to prevent. Action step 2. Decide on your form before you buy. Gold comes in 3 primary forms. Physical gold, coins or bars you hold directly, has no counterparty risk. If the financial system itself is under stress, physical is the form most insulated from that stress. The downside is storage, insurance, and slower liquidity. Gold ETFs, funds holding physical gold, are liquid, low cost, and easy to hold inside any brokerage account. The downside is they are paper claims on gold, which in a severe enough disruption may not behave identically to physical metal. Gold mining stocks amplify gold's moves. When gold rises 20%, quality miners often rise 40 to 60%. But they carry equity and company-specific risk that pure gold doesn't. Most investors are best served with a combination, 60 to 70% in a reputable physical gold, ETF for liquidity, 30 to 40% in physical coins for true crisis insulation. Action step 3. Build the position gradually. Gold has already moved as tensions have risen. Buying everything today means buying at a price that already reflects some fear premium. Spread the purchase over 3 to 6 months. Same amount, same date each month, regardless of price. You average in without the regret of having bought everything at a short-term peak. It's 2028. The conflict has been running 16 months. Currency volatility has been significant. 2 central banks have quietly increased their gold reserves by over 20%. Gold is trading at levels that would have seemed extreme in 2024. Victor, who never built a gold position, has watched his equity portfolio fall, partially recover, and fall again with each escalation cycle. He's down 14% from his 2024 peak in nominal terms, and more in real terms as wartime inflation has compounded. He held through it, which is better than selling, but he has nothing that moved against the tide. Dean's gold allocation is up significantly from his cost basis. His total portfolio is up 8% from his 2024 starting point despite the equity volatility. because one position moved in the right direction at the right time. He's not rich from it, he's intact from it. And intact, in a period like this, is winning. Same world, same conflict, same 2 years. One had a fire extinguisher. Here are your 3 takeaways. 1. Gold's value in a portfolio is not about making money. It is about preserving it when the system's underlying other assets are under stress. Every time institutional trust has been seriously threatened in the last century, gold has done exactly what it was designed to do. A World War III scenario is precisely the environment where that matters most. 2. The right allocation is 8 to 12% of total investable assets, enough to meaningfully offset crisis losses, not so much that it drags long-term performance in the calm periods between. Split between a reputable physical gold ETF for liquidity and physical coins for true insulation. Build it gradually over 3 to 6 months. 3. The worst time to buy a fire extinguisher is when the house is already on fire. The window to build a gold position at pre-crisis prices is not infinite. Every escalation event moves the price higher and narrows the entry. The investors who benefit from gold in a crisis are not the ones who bought it during the crisis. They are the ones who bought it before anyone was certain the crisis was coming. Gold doesn't predict disaster, it just survives it. Make sure some of yours does too. Please like and subscribe.